Greetings, Dr. Hassan. Thank you for virtually joining me this evening. I assume you've had no problem accessing the attached PowerPoint. Anyways, I'm not sure if you've heard, but Mr. Quinones from Quinones Corporation contacted us and had a handful of questions regarding how the new legislation will affect his business this coming tax year. We have scheduled a lunch meeting with him this Monday to go over some important information and offer our advisement. I want to assure that we're extra careful before delivering our research to Mr. Quinones. Of course, no one is yet an expert on this new piece of legislation. As you know, this is the first major tax reform in 31 years. After further research, I've identified 5 key changes that will affect Mr. Quinones' corporation. Additionally, I think it would be beneficial to touch upon these changes during Monday's meeting. These topics include the new corporate tax rate, changes in net operating loss treatment and carryovers, decreases in dividend received deductions, the dismissal of the corporate AMT, and the expensing of certain business assets. I have provided a brief summary on each topic, elaborated the effects, and have some potential suggestions on planning strategies for this coming tax year. I have utilized both the old legislation and the new Tax Cut and Jobs Act to assist me in my research. Before we jump right in, I took the liberty to acquire some historic and predicted financial measures regarding the Quinones Corporation to add monetary context and truly highlight the effects of this new legislation. Quinones Corporation had a $25 million taxable income in 2017, and we are predicting a similar figure for 2018. The corporation has carried forward and a net operating loss of approximately $2 million from 2012. The corporation received a total of $1.25 million in dividends, in which $750,000 derived from corporations less than 20% owned, and $500,000 coming from corporations more than 20% owned. The corporation paid $1 million of alternative minimum tax in 2017, and lastly, the corporation purchased both new and used assets totaling $8 million throughout the year. Now that some of the background information has been addressed, I will move on and dig deeper into the changes to come. Do you have any questions or anything you'd like to add before we move on? As displayed on the PowerPoint, there's a drastic decrease in the tax rate for corporations. The 14% decrease will cause a $3.5 million decrease in tax liability for 2018. That should make Mr. Quinones very happy. Next, we will move on to the net operating losses. Under the old law, a corporation could offset 100% of its regular taxable income with a net operating loss carryforward. Old legislation has also generally allowed NOLs to be carried back 2 years or forward 20 years. The new legislation excludes carrybacks for NOLs generated after December 31st, 2017, and introduces an indefinite carryforward period. In addition, after 2017, the corporate NOL deduction for a given year is now limited to the lesser of all NOL carryovers and carrybacks, or 80% of taxable income calculated without consideration to the NOL deduction. Please note that these new rules apply exclusively to NOLs generated after 2017. Existing NOLs that were generated in tax years ending prior to 2018 are still subject to the old carryforward and carryback rulings. This means Quinones Corporation's $2 million NOL carryover from 2012 is still subject to old treatment. Under the new legislation, Quinones Corporation will lose around $263,000 due to the decrease in the deductible thresholds. Prior to 2018, corporations received a 70 and 80 dividends received deduction when ownership in dividend-paying corporations was less than 20% and greater than 20%, respectively. Starting in 2018, the dividends received deduction will drop to 50% and 65%. As a result of this decrease, it would be wise to reevaluate Quinones Corporation's portfolio and consider divesting from certain investments. The corporate alternative minimum tax has been repealed under the Tax Cut and Jobs Act. This will work in Mr. Quinones' favor, having paid $1 million of AMT in 2017. Additionally, AMT credit carryforwards may still be utilized to offset a corporation's regular tax liability in future years. I also read that the new law allows for a partial refund of AMT credits. However, I'd prefer for you to further elaborate on that topic since you're extremely knowledgeable on that subject. Lastly, new provisions regarding the acquisition of certain assets could play a valuable role for Quinones Corporation in coming years. Under the new legislation, 100% of the cost of certain new and used business assets may immediately be expensed if placed in service after September 27 of 2017 and before 2023. There will be a phase out of this bonus depreciation for assets placed in service after 2023. And that goes as follows: 80% for property placed in service in 2023, 60% of property placed in service in 2024, 40% for property placed in service in 2025, 20% for property placed in service in 2026, and finally ending at 0% for property placed in service in 2027. Therefore, the majority of the $8 million in assets placed into service during 2018 are likely eligible to be expensed in full. With this increase in deductibility, it is advisable to expedite the acquisition of needed qualified assets. I find it important to note that even with all these changes taken into consideration, our tax planning strategy remains ordinarily the same. So if you don't have any questions, I think our meeting is a wrap. See you Monday.